and probably how do you interpret the risk and return of risky assets, and if I bring in a risk-free asset to that combination, what kind of impact that comes, and what are the various terminologies that come out as a part of the basic calculations in this portfolio risk and return calculation is what is being covered. So the first part of this is a very simple scenario where some part of it came up in quant, finding out the different types of returns, the holding period return, right, in multiple period, whether to use arithmetic return or a geometric mean kind of a return. These are again some portions that are repeated from there. But yes, gross return. What is the difference between a gross return and a net return in case of a portfolio? When we say any gross return, we are removing the brokerages or any kind of commissions, advisories. They are all typically removed. It's as good as saying, let's say, whether you are, even if you are a portfolio manager, right? When you have purchased the shares of something, after that you sold them, what you have actually got, you will get only after the deduction of the brokerage fee and the commissions and all whatever have to be paid. That is the amount that you are going to get. So whenever we use the word called gross return, we talk about after the deduction of the brokerages, especially those costs which are needed for transactions, not the fund management costs and all. The fund management and all are done by the fund manager. This fund manager is investing in the stocks, let's say, somewhere else, right? So they are invested over an exchange, and the exchange is charging some brokerage and or through a broker. The broker is charging some brokerage. Exchange is charging some transaction fees. All these things, they have to be removed, and a gross return is what is computed. Out of this gross return, if I remove the fund management fee, because I will charge something. See, there are three layers here. Clients are investing the money with the portfolio manager, right? Portfolio manager is probably saying portfolio manager is managing a client's portfolio. So client is giving money to the portfolio manager. The portfolio manager is investing. Whatever the return, the portfolio, whatever the cost the portfolio manager is incurring in the process, the difference is what, let's say he has invested 100 crores. The fund, the stock prices and all have gone up, and overall it has become 105 crores. But because of this buy-sell transactions, 1 crore has gone into transaction fees and brokerage charges. So what the fund manager actually got is only 104 crores. Right? The gross return is only 4% there. And what the client gets is what is the net return. So what is the difference there? The fund manager will say, oh, 2% is my fund management fee, or annual fee is something. Some administrative expenses are there. All these things after deducting whatever the benefit the client is going to get, that is called as a net return. Whatever the benefit, probably look at it like this. Whatever the benefit the fund manager is going to get is what we call as a gross return. Fund manager or portfolio manager. Here let me use these two words interchangeably. Whatever is the benefit the portfolio manager is going to get is what we call as the gross return. Whatever the return the end client is going to get is what is called as a net return, because we remove the administrative fee, fund management because he is doing some research and lot of things, he'll charge something. Generally it would be like some percentage of the assets under management. The total money, whatever the fund he has invested, Let's say 500 crores he has invested, 2% of that 500 crores is what typically goes as a fund management fee. So like that, we look at the gross return versus the net return. And again, we have to define between pre-tax and post-tax, because whatever the benefit that whatever the profit that comes out, there is a tax that has to be paid on that. So we have to see whether that return that we are getting is before the payment of tax or after the payment of tax. Whether it is real or nominal. Nominal is it includes inflation also, but real means it excludes inflation. What is that return someone is talking of? Whenever someone uses return, these are all different ways of defining your returns itself. What is that return altogether? Is it a gross or a net? Is it pre-tax or post-tax? Right? If it is pre-tax, what is my post-tax return? Because at the end, what I really want is, as an investor, what I really want is, what is my post-tax nominal rate of return? Or post-tax real rate of return. One of these two is what I require. Probably I am fine with nominal also. Even if the inflation is there in the market, how much I am getting. Right? I am more bothered as a person who has contributed to the fund. My intention is, what is that I am finally getting after tax and everything, what is that I am typically getting. So whenever we talk about returns, because sometimes what happens when we look at on the websites of the fund management companies, they publish some return. It need not be a post-tax kind of a return. It may be a simple pre-tax return. So right, when they advertise, so they will mention that in small disclaimers, these returns are pre-tax kind of stuff. So you have to be very careful in judging all these things, all the worth of each of these funds. So that's where some understanding of these things is required. Then we also use a very good concept called leverage return. Today, we have the concept of margin. You only deposit some X money, but do the trading for 10x. Just by depositing, let's say 1000 rupees with the broker, you can do the transactions worth 10,000 rupees. Because it hardly matters. The broker will get his commission for 10,000. Right? And it's like broker has given you a loan for the remaining 9,000. The broker has given you a loan, and he will set the system in such a way that if your total 10,000 is falling below 9,000, he'll do an auto sell off without you actually selling it off. The system will do an auto sell off and he will recover his 9,000 back. You're getting the scenario, right? Today there's a lot of trading that happens purely in a margin based. So look at it like this. Let's say you had 1,000 bucks, right? You have bought 10 shares of 100 rupees each. 10 shares, 100 rupees each you have purchased. Now let's say after 1 day or after 1 day, let's assume that this 100 rupees has become 102 rupees. So your 10 shares have become 1020. So you have got a profit of 20 bucks or probably 2% is your total profit. This is a normal cash based transaction. Now when I go with a margin base, what will happen? The same 1,000 which I have, I'll get into a margin trading. So what the broker will do, the broker will add 9,000 to it and say, now you can, I am giving you, now that you have deposited 1,000 as a kind of a security, I'll give you 9,000 as excess loan. So you can do your trading for 10,000 bucks. Right? So because he is doing a trading for 10,000, he can buy 100 shares of 100 each. Instead of 10 shares of 100, he can buy 100 shares of 100 each. Now the same, if it has gone to 102, right? His total money is becoming 10,200, right? Out of that, the broker's part is 9,000. You refund back the broker's part of 9,000. 1200 is what is left. With the 1000 which you have put, you have actually got 1200. So you have got 20% return. That is what we call as a leverage return. The return which you are getting because of the margin trading process. Borrowed funds. After refunding whatever the borrowed amount, whatever you are left with, is what is called as a leverage return. Especially with the margin trading process, the total derivatives world trades on margin trading itself. But the same problem comes the other way also here. Right? If the share price instead of 100, it goes to 98. In a cash base, you must have lost only 2%. In this base, you will lose 20%. So, leverage return is very highly risky compared to a normal return. But people play on that. Right? So, that is what we have to compute in some of the cases, especially when leverage is involved. Leverage is nothing but borrowing. The word leverage, especially when leverage is involved, borrowing is involved, whatever the return that I am talking of is my contribution of money, how much I am left with. Right? Because after I contributed something, someone else has lent me something. But for that party, once I refund back, everything else is mine only. Those are the returns which we call as leverage kind of return. So in a portfolio case, we have to understand all these kinds of returns because we involved in getting at each of these layers. Now, with respect to the portfolio, this is something which we have looked at in quant also, the covariance between the two securities. Right? We have defined correlation earlier. Correlation is nothing but covariance divided by the standard deviation of security A into standard deviation of security B. So we can define it. Let me put it into a spreadsheet directly. See, we have already defined earlier that correlation is nothing but covariance divided by the standard deviation of both the security. Standard deviation of A into standard deviation of B. So this is one important aspect that comes into the entire world of portfolio management. So probably what we'll do now is we'll take some example and first drive that example, then probably we can get back to the theory part. Let's say I am talking about two securities, A and B. A is giving a return of 20% and B is giving a return of 30%. And let's say the standard deviations or the risk that is available with A, let's say it's to the extent of 25% and with B it's around 40%. So I have, so higher the risk, the first thing that is coming out for us at this moment, higher the risk, higher is the return. So this is having a high risk, so probably it's giving a higher expected return. So these are expected return, right? Because it's having a high risk, I'm expecting that it will give me a high return. So probably it may go the other way also. But as an expectation, I'll show this kind of a return. And I'm also saying that the correlation between the two securities, these A and B, let's say is around 0.5. It should lie between -1 to +1. So I am just assuming that it is around 0.5. So based on this, I can very well compute the covariance. The covariance is nothing but correlation into the two standard deviations. So I am taking it as correlation multiplied by the standard deviation of the first one multiplied by the standard deviation of the second one. So overall the covariance is some 0.5.